The devastating war in the Middle East entering its second week as Israeli forces prepare for a ground operation in Gaza. This as rising tensions with Hezbollah at the Israel-Lebanon border are ramping up concerns that the conflict will expand. U.S. markets are closely watching all of this play out. Joining me now is Invesco Global market strategist Brian Levitt. Brian, thank you so much for joining us.
My pleasure. Thank you.
So, starting with the Middle East, we're not seeing much of a reaction in U.S. markets, even in oil prices. Why is that, and what's going to cause that to change?
The markets have become accustomed over time to not paying significant attention to regional events. I mean, you typically have to ask yourself, does this event change the trajectory of the U.S. economy, and does this change what the Federal Reserve is going to do? In both instances right now, the answers appear to be largely no, unless you see a wider confrontation emerge, a sustained rise in energy prices. But for now, I believe the answer to those questions are being answered as no.
And just want to turn attention to Washington now. We are seeing maybe a little bit of chaos on who's going to be the next Speaker of the House. Again, the market does seem to be ignoring that right now, but is there a point where the market will be paying more attention? Yeah,
I mean, again, it's something that the market has grown accustomed to. So conflict in the Middle East, some dysfunction in Washington, D.C. We've seen these things before. Now, Congress needs to have an appropriations bill, and we need to keep the government open by November 17th. Congress was supposed to be in recess over the next couple of weeks, so the market is not paying attention right now. Ultimately, Congress tends to act when there's a need to act. Goes back to that Churchill line about Americans doing the right thing, but only after exhausting all other options. So I believe we'll get there. And we will be able to, spend what needs to be spent and keep the government open.
Okay, so we talked a little bit about some of the things that the market and economy are maybe ignoring or just not focusing on so much. But what are some of the economic indicators that matter most now?
Well, the big news has been how strong retail sales was in the latest reading, and the jobless claims number, which continue to be strong. So it's pointing to the U.S. consumer resilient and the job market very strong. And typically, investors would say, why isn't that a good thing? Usually good news is good news, but the market right now is treating good news as a little bit of bad news because inflation's still above 3%. You would need inflation probably closer to 2.5% in order for good news to be good news. So when you get this good news, interest rates go up, and equity valuations have been adjusting as a result of that.
Yeah, it's always tough to know that, okay, when do we want good news to be good news and bad news to be bad news and all of that? But tell us, what does that mean for the path that the Fed is on now? We did have a speech from Jerome Powell on Thursday. Just curious what your take was on that and what you see the Fed doing going forward.
Yeah, I mean, the Fed basically told us that they're data dependent, which is interesting because Fed policy operates with a lag, but they're going to be data dependent. So we'll see what that means. The market expects the Fed is done. If you look at the Fed funds futures market, the market believes that the Federal Reserve has increased rates for the last time and actually believes that interest rates will be 4 3/4 a year from now, which means an easing cycle will start. I'm a little bit less concerned what they do in the next one and more concerned in what they do in the series of meetings after that. I think we're at or near the end of policy tightening, and typically the end of policy tightening creates a better backdrop for risk assets.
So just curious, if we are at the end or near of policy tightening, was the Fed able to do a soft landing? Are we going to see a recession?
Well, we don't know yet. I think it's probably too overconfident to think we can get through this without some form of economic downturn. Now, the good news is for investors is we priced it last year. Right, we were down 25%, which is very much in line with an average return during a more mild recession. Typically what you see, I think investors have forgotten that we can have mild recessions because 2020, 08, 01 were so disastrous. You can have more mild downturns where the market falls 20, 25% and you're back at the new high within a year or two. Those are years like 1991, 1981. So that's how I would view this. We're trying to navigate some weakness in the economy. The Federal Reserve can pivot. If you get to a place where you have already seen peak inflation, peak tightening maybe here, peak rates, usually that's a good backdrop for equities and for credit over the subsequent years.
So real quick, you say it's a good backdrop. How would you position?
I would be positioned to think about what a new market cycle would look like. I think the way investors are positioned right now, you have a lot in money markets and cash, which are yielding 5.5%, which feels nice, and actually a lot of money in growth tech stocks just because of how the markets have played out over the last year. So I would say lock in some of those yields. Don't just like it for 30 days. Move into corporates or municipal bonds so you can lock in some of those yields. And on the equity side, diversify into more cyclicals, value, smaller capitalization stocks.
All right. Well, Around the World with Brian Levitt, thank you so much.